Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. Do you need a financial advisor? It is a question that I've been answering for 23 years, and we are going to dive in because Vanguard themselves is telling us, yes, you do. Welcome to Wealth on the Move, the podcast. I'm your host, Will Hoffman, founder and president of Hoffman Wealth Management. And today's going to be a crowning day for me. We're going to get to our, I don't know if guest is the right word, but probably becoming more of a mainstay on the Wealth on the Move, the podcast, our director of financial planning, Niko Rosso. We'll introduce him here in a second. 25 years ago, I wasn't even in this business yet. Niko, who we're going to meet in a second, wasn't even born yet. Vanguard decided to do a study and to drag it out over the next 25 years and talk about the value that financial advisors can add, or can they add value? They called it Advisors Alpha. For those that want to know, Alpha is how much value that management or financial advisors are adding to a particular financial situation. It's a term that we use all the time in our profession, and they named it Advisors Alpha to study how much, if any, value a financial advisor was adding to their clients and what areas. And it's very telling. It wasn't a surprise to me, especially in the areas where we have the most impact, because it kind of lines up where I've seen us have the most impact for 23 years now. But I want to make sure that we communicate this to our listeners and at least help you understand when it comes time to shop for a financial advisor, things to look for, things to ask about, things to inquire about, so that you make sure you're getting the best advisor for your particular situation. That said, I do want to introduce you to Niko Rosso, the Hoffman Wealth Management Director of Financial Planning. Niko, welcome to your first of many appearances on the Wealth on the Move, the podcast.
Yeah, I'm excited to be here. Hopefully familiar faces for some of our audience, at least. Not exactly a guest, but first time on the podcast, and I'm excited to be here.
Yeah, and Niko has been doing a great job for us, delivering just immense amounts of value to our clients, explaining financial plans, doing the financial planning, and understanding and learning how this planning impacts our clients' lives. So I thought he was a great guest or great person to get some insight from when we talk about this Advisors Alpha program from Vanguard and how we help our clients and when I say we, I mean financial advisors as a whole, not just Hoffman Wealth Management. But Niko, why don't you give our listeners a bit of a history about Niko Rosso, where you're from, how you came to Hoffman Wealth Management and your role here.
Absolutely. So I guess I came to Hoffman Wealth Management in high school, which was a little bit of an odd track. Fair enough. I had some credits where I was a little bit ahead in high school, and I thought I was going to be smart taking 4 study halls and just taking a half day of off. And the guidance counselor calls me down and says, you can't do this. And I was like, well, yeah, I can. I'm going to graduate. Everything's going to work out, and, we'll part ways in May. And he goes, well, don't you want to take AP biology or AP chemistry? And I was like, no. Fortunately, at that time, I knew I wanted to do something in business. At that moment, I think I thought I wanted to be an accountant. And our school would do something called the VOTEC program, where a lot of the students who knew they were going into blue collar industries would leave school and go learn welding, plumbing, whatever in the blue collar industry for half the day. And I said, well, can I go shadow someone in business, like for half a day? They're doing it. Why can't I go do it for a business path that I want to pursue? Right. And ultimately ended up connecting with Will through a local bocce club. Funny enough, his wife was my 5th grade teacher. So there was already a small connection there, and approached him. I really wanted to study Will specifically because he's a sole proprietor. So he owned his business back then, and he did everything. He knew accounting. He did his own marketing. He had an office manager at the time. That was really it. So he did everything. So I got to see everything from accounting, marketing, finance, all in one. And it was a very brief experience. I got to sit there and watch him for half a day. I didn't even know what he was talking about most of the time. It was really the exposure.
Told Niko, neither did I.
It was really the exposure, and then, it all translated to eventually I went to John Carroll, um, and I was sitting in my first finance class, and I was like, "Hey, I've heard that before."
Yeah.
Like, I know what that means a little bit.
Well, and
I've
you were
seen it.
you were in kind of a unique program at John Carroll, right?
Yeah, so John Carroll, my second year there, was starting what they called their, financial planning and wealth management track. So, different from a finance degree a little bit. We still took investments in a couple of the general finance classes, but what they established was a fast track for the CFP designation. And you had to take 8 classes. You had to take behavioral finance, estate planning, tax, investments, etc. And all of those classes were taught by, say, tax was taught by a tax attorney, which you don't get that
Right.
opportunity a lot at schools. Estate was taught by an estate attorney. Investments was taught by a CFA. And then ultimately, my main teacher for that course was a CFP practitioner himself. So it was a unique experience. It was kind of like a pilot program. It wasn't established. At first, they didn't really know the direction, but a lot of credit to my teacher. He did a fantastic job. And anyone that's going to be a financial planner or financial advisor, I would highly recommend pursuing a program like that, whether it's at John Carroll or another college.
Yeah. And if any of my peers are listening and you are looking for the next generation of your firm, I would highly encourage you to take a look at the program that John Carroll has and their upcoming or recent graduates, because Niko has immediately been able to have an impact on our firm with things that helping us organize the things we want to do when it comes to planning, helping us really his biggest talent is being able to explain these planning techniques and planning strategies to our clients. Because as we're going to talk about here in a second, there's a lot. I had a client the other day who, we were going through some things on a very, what would seem like a very simple decision-making process. And her response after we asked a few more questions was, I can't believe the stuff you have to know when it comes to making decisions about your money. And I think that's a great segue into the study that Vanguard did, because it's amazing what you have to know. It is amazing what mistakes you can make without even realizing you're making a mistake and thinking you're doing the right thing and doing everything in your power to get your money moving in the right direction, getting your wealth growing and trying to make yourself and your family prosperous. And then all of a sudden the tax man cometh and you understand what happens. And again, the with what's everything that's been going on in the last couple of weeks, we have seen this become even more important. No secret, it's been a volatile couple of weeks in the news, all that right around the remembrance of September 11th, which is right when of 2001 was when Vanguard was starting this study. We have been flooded with inbound calls from folks wanting to know, do I have to work this long? Do I have to work much longer? When can I start to earn less or make less? Because listen, it's Niko, you were just a baby, but very few times do we have perspective inducing events like what we've gone through this week. And I think they're even more perspective inducing because they were coming on the heels of September 11th. And all of those thoughts for folks in their 30s and above, they were remembering what it felt like that time. And folks asking the question, how much longer do I have to do this? How much longer do I have to work this hard, travel this much, be away from my kids? And it's common during these points of inflection that folks have those questions. But Vanguard studied some very, very important things. And we're going to put a copy of this in the show notes, because, and somebody that Niko and I just got to meet, Josh Brown, was spot on when he called this the most seminal thing ever written about financial advisors, because it shows the value that we can have. And they talked about investing. They talked about different planning when it comes to either tax efficiency or financial planning. They talked about asset allocation. And to me, the biggest thing that was analyzed, and we're going to save it for last, is behavioral decisions. And I know that that's where I see us having the biggest impact, is helping coach through different behaviors when it comes to market volatility, when it comes to spending or overspending. And we did a few episodes on lifestyle creep and why that can be detrimental. And they talk about that. So we're going to get into that here and talk about the impact that advisors seem to have. The first thing I do want to talk about is the investment selection. Niko, I don't know if you've noticed in your beginning part of your career here, folks seem to think we have all the good investments.
Yeah.
And and I don't know if it's because there's 4 or 5 different news channels around our profession, and they seem to only be talking about investments. And they talk about some macroeconomic things, but how it impacts our investments. And investments matter without question. Investments are important. We don't have this locked vault of great investment ideas. Would you say that's true, Niko?
Yeah, absolutely.
I mean, and if we do, I haven't told you where it is yet. But
We wouldn't be in Jeanette. We'd be in an ivory building in New
right,
York City.
if we knew where all the good investments were, right? But it's kind of like going to the doctor and thinking the doctor is going to they're going to give you the good medicine and they're going to give you the cure. And if you're not taking care of yourself, it doesn't matter what the doctor says. And it's the same when it comes to this stuff. If you're not doing everything and understanding savings and financial discipline and asset allocation, it doesn't matter how you're invested. Investment selection, I think it's starting to become viewed as less important, and that hurts because I know we put a lot of time in our portfolios. We put a lot of time into the research and we inquire with the minds that we respect when it comes to building portfolios. And Vanguard sees that and notice that we can add anywhere from nothing to upwards of 1% to portfolio management. They have a great chart. If you're downloading this, it's on page 3 of their diagram. They have a great chart where they show that 0 to 1% based on investment selection. We want a large cap growth fund. We are looking at all of the large cap growth funds and diving into their expenses, their costs, their managers, their philosophies, all of that. And I think that that's what they think adds 1%. So, Niko, you would agree that the work that we're doing when it comes to building a portfolio, you can see why Vanguard's study indicated that investment selection, we add alpha, we add value in that space. And it's not because we know where the good investments are. It's because of the work that we do for dissecting how they're invested or what the philosophies are of different funds or ETFs.
Absolutely. My portfolio take has always been and always will be that math doesn't lie, cheat, or steal. There's a
Right.
lot of variables that go to investing, and it's, a lot of it is, sure, I want the return in the end, but at the same time, you've taken account all the variables. We want tax, where should I own what, and why do I own this, and what timing should I own this? There's a lot of factors that are involved in this, and data will be wrong eventually. Like no one saw 2008 coming, or very few people did, and there
Right.
wasn't an index or portfolio in the world that was isolated from that. There's going to be major risks like that, but you can't plan for that. You have to take the information you know now and work off of that. That's all you can do to put yourself in a position where you reach the goal that you came to us for.
Right. And if you're shopping for a financial advisor, it's important that you understand their process, their portfolio design process, because again, after 23 years of experience, I know they've become more sophisticated. I know that we have become more sophisticated over time on how we create and analyze and develop portfolios. That said, sophistication doesn't always mean bulletproof. But
Absolutely. And I read a book.
understanding, go ahead.
Oh, sorry. I read a book the other day. I've been telling you about this all week. It was The Wealth Ladder.
Mm-hmm.
And it brings a very good
We're going to
point.
hope
So
to get Nick
basically,
on the podcast here too. Nick's
absolutely. It's an
smart
awesome book.
guy, great author. Check out the Wealth Ladder.
And it talks a little bit about like drops in the market and at different asset levels. For example, if you have $10,000 in the market and you lose 10%, that's $1,000 lost. A lot of people are able to stomach that. It's okay. Now I have a $10 million portfolio and the market
Right.
went down 10%. $1 million just left my statement. So, it only gets more complicated as you go up. And you may say like, oh, I can handle the index right now because my 20% drawdown's only 2,000. But if you had $10 million, or you forget 10 million, if you had $1 million and you had a 20% drop, you just lost $200,000 of your life's hard
Right.
work.
Well, and you just touched on something, and I don't know if folks picked up on it. Not just asset allocation and portfolio design, But Vanguard also has found that advisors are having a huge impact when it comes to asset location. Almost, it's a little bit greater than 0.5%. So we're immediately in the first two topics when it comes to investments at 1.5% of potential value that a financial advisor can add. Can you talk a little bit about what asset location is and what we mean when we say asset location?
So just speaking broadly, there's three main types of account. One's a non-qualified account. In simple terms, that's a bank account that you can buy stocks, bonds,
Sure.
ETFs, mutual funds.
Non-IRA, non-retirement based, no, every decision has a tax consequence, but that money is yours without regards to what age you are.
Absolutely. And so income products like that, if you get dividends or interest on, say, like a CD or something, that counts as normal income to the tax code, which we're not going to get too far into because it
Right.
can get pretty complicated. Then you have like the Roth accounts where you put money in after tax, grows tax free forever, comes out tax free after 59 and a half. And then you have what probably most people are familiar with because the 401k has made this the most popular is your traditional type accounts where when you put money in, you get the tax break up front, but every time you pull it out in the end, you get taxed. So just think
Right.
of those as the three main accounts, the non-qualified, the Roth, and a traditional account. And all three of those have different tax effects. In asset location, understanding what investments do what. So if you have a bond fund, you're more likely to get interest than appreciation
Right.
in a bond fund. So if you're a guy that's in, say, let's just use the top rate, if you're in a 37% federal tax bracket, you may not want to own a bond fund in an account where you're going to be taxed on it because say you're
Right.
getting
Because that
6.
income is now taxed. That dividend or that income or interest gets taxed at that massive tax rate.
Yeah. So you're just giving money to the government that you don't have to.
Right.
And that's obviously typically against the objectives of investing is you want to keep as much money as
Right.
possible. Right. Or if this is my favorite when people call in and they heard some speculative stock and they have some play money and they really want to buy something that they think could 10x over years. And we warn them of the risk and everything, but if you really believe that that's going to have that kind of appreciation, in my opinion, we're putting that in your Roth. Your Roth, in my opinion, should typically be your most aggressive account because that's one of the only opportunities you have in the world to create tax-free growth.
Right.
So you
And
obviously
tax-free
want your
estate.
most,
Like that's
yeah,
tax-free in a lot of regards. Right. So
absolutely.
just those instances and examples right there can explain how not just having an opinion or a philosophy on how you're invested, but also which type of an account those investments are in creates. I mean, so we're talking there about a 1.5% impact on your portfolio or on your investments or wealth already. And then while we're talking about tax, between the two things that where we can help when it comes to taxes, and we have to be careful because we can't deliver tax advice, but we can help you create a tax efficient retirement. So what we mean by that is examining, again, asset location. Niko had touched on the Roth versus a traditional or 401k, and understanding how those assets are going to be taxed when you retire. Because there's, in my opinion, a fallacy that folks have heard when it comes to 401ks, and it's when you retire, you're going to be in a lower tax bracket. Rarely do we see it. On occasion it happens, but you're building this giant traditional 401k that is just a ticking time bomb when it comes to taxes. And if you're not using it wisely or strategically distributing from it when it makes sense, you can end up with a tax nightmare. And
Absolutely.
a tax nightmare when you're at an age in a situation where you may not be able to control it as much.
And kind of counterpointing that too, I think if you Google investing, you'll hear the word diversification. And it often relates to actual investments you make. I think that there's a downplayed value on the importance of diversifying investment accounts.
Yeah.
Not
Great
even
insight.
just your investments, your investment accounts.
Yes. Yeah. Tremendous insight.
Yeah. So if you have all three accounts, you can kind of pick and choose. You're going to need money at some point in your life from your investment accounts.
Right.
And when you have all three of the general types of accounts, you can kind of pick which taxes you want to pay or no tax at all. But if you only have, say, your 401k or a traditional IRA, you don't have the luxury of not recognizing income tax every time you need money.
Right.
So that's an underplayed value to investing that a lot of people don't understand. And when someone comes in at 60 that's never worked with an advisor before, that's probably the number one issue we have to fix is they don't have diversification of investment accounts.
Right. It's called the tax control triangle. We could do an entire hour-long episode on the tax control triangle. And maybe we will. But it's understanding what investments are taxed and when they're taxed and how they're taxed when you make certain decisions. And it can change. And the other thing that can happen is when you're investing outside of a qualified plan, whether it's a 401k or an IRA or Roth IRA or something, there's also tax loss harvesting. Can you talk a little bit about what that is if folks aren't familiar, and why that becomes important and when becomes important?
So tax loss harvesting, essentially what you're doing is you're recognizing long-term capital gains. And this is happening in the non-qualified account
Sure.
where it's like the bank account with stocks and bonds. And what you're doing is if you lose money in that account on a specific investment, let's say you
Yeah, as you
bought an
say, you
energy,
bought a stock and it went down,
yeah,
which is
it went
going
down.
to happen. I will assure you that that's going to happen somewhere in your wealth journey. Your financial advisor is going to pick a stock, an investment, make an investment decision, and it will go down.
Absolutely.
That's a foregone conclusion. Accept that now. Your advisor's not bad because it happened. You didn't make a mistake. It's just going to happen. Go ahead, Niko.
Yeah.
I'm sorry, I didn't mean to interject there.
No, and you're good. And there's incentives to the losses too, right? So the government says you can write off capital losses against capital gains. So, for example, if you're in a year where you need capital losses, say you sold a business, you could take the losses on certain investments
Yeah.
and help offset the gains in your business. Or, for example, if you bought Apple in 1980 and Apple has grown from what Forrest Gump calls a small fruit company into this giant tech
Way to
stock.
kiss up to the boss, buddy. You know that's my favorite movie.
There you go. And you have this large gain in Apple, and you've recognized now it's 2025, and maybe Apple doesn't have the same growth left. And we're not making investment advice on this. This is
Right.
nothing against Apple. Do not trade on this. But maybe you think that Apple's had its run.
Sure.
Well, now you can take some of those losses to help you get out of that Apple position and, pick another investment. And you
Yeah.
use the losses against the gain to free up that cash.
Well, and it's more, we're coming up on the fourth quarter. We're coming up on the end of the year, and that's when a lot of those conversations happen. And it's not always the best time for those conversations to happen. Admittedly, we will have a lion's share of those conversations now. But if we go back to the beginning part of 2022, we had a pretty volatile spring. That's also a good time to have those conversations because, the market was giving us some headaches. Tariffs were being introduced and the market wasn't responding great to it. And history has told us the market will go through these pockets of volatility. And that's also an indication that maybe there's some opportunity for some forward planning that doesn't revolve around making sure your investments just go up or making sure that, we stay the course. It's also a great conversation to have things from a tax efficiency conversation, like tax loss harvesting. When the market's down, it's a great time to have a conversation about Roth IRA conversions because ideally the market's going to come back up. History has told us that that's been the trend, and whether it happens quick or slow depends on why it went down, but it gives us an opportunity to have some more of these tax efficient conversations.
Absolutely. And I think one of the biggest misconceptions, and it scares a lot of people away from tax loss harvesting is, why would I sell in a down market?
Right.
And essentially we're selling to free up money to reposition. We're not
Right.
taking this money out of the market and holding it out of the market forever. We're selling to reposition you, and hopefully we participate in the rally based off the reposition.
Right.
It's not pulling money out of the market or anything like that.
Well, and then and you just touched on the last topic that was, well, by the way, that tax, both a combination of the tax efficient retirement strategy, Vanguard their study has said up to 1%, and tax loss harvesting can give up to 1.5%. I love that they say or more afterwards because they're not quantifying this, and they're seeing that can have a greater impact than 1 or 1.5%. But the one area that I wanted to highlight the most. And it's the one area that has had the biggest impact based on Vanguard study. And it is behavioral coaching. Over 23 years, I am confident that that is where the most important discussions have been, in my experience with our clients. It's where that I've seen that I know that my peers and I are having the most impact. I see that it's where the biggest mistakes can happen and where the biggest perils occur is around our behaviors. And I can't stress that enough. Because Niko had touched on it, the market's down. I don't want to sell now. Well, you're right. That's kind of a good behavior because we see so much of the opposite is they want to have conversations about vacating the market. And, I don't know I think it was JP Morgan that says when there's blood in the street, that's when there's opportunity also. And beyond that, the lifestyle creep, which we spent a few episodes on when we made the conversion to Wealth on the Move. Behavior is where the biggest impact can be made. And I'm harping on it right now. I cannot say it enough. Behavior is where the biggest impact can be made. Niko, and you being in the beginning part of your career, you haven't had as many of those conversations as I've had, but you have been able to quantify that in a financial plan.
Absolutely.
Can you talk a little bit about how you see that? And there's, again, math doesn't lie, cheat, or steal. The math, simply the rule of 72. It's the one thing that when we go talk to high school kids, that's what we talk about when we try to make cases for folks changing or improving their behavior. The rule of 72 is the greatest example of why financial decisions that are happening in the moment right in front of you need to be thought about 20, 30, 40 years down the road.
I think the biggest pro of a financial plan is the behavioral side. I think a financial plan itself is all it does is educate your client on what we're doing and why we're doing it. We're sitting down, we're talking about this plan, or even just a section of the plan. And my goal leaving that meeting is one, to execute, but also that client needs to understand the ins and outs of what we're doing.
Sure.
So for example, I have clients that we're doing Roth conversions for, and however your strategy is, that's up to you. I don't want to go down that because we could spend 5 hours on
another
that.
episode, right?
Yeah. But in April, I had a client, we have a plan, and we know we convert every year.
Right.
That we're converting every single year. And the market took a little nosedive off of some information, and it was quick. And I called him and I said, he's like, oh my gosh, is the market tanking? No. Here's what we're going to do. Here's the plan. We know we're converting X amount this year. I say we do half right now. We know we're going to do it. We had the plan. We had the savings for the taxes. We know we're doing this at some point this year. It's at a discount because the market's down. Let's do it. And that move worked out really good. He was very accepting of it because that was the plan from the start of the year, to do it at some point that year. And
being proactive with those behaviors becomes so important. Budgeting.
Yeah.
Budgeting sucks. I'm just going to say it. Budgeting's not fun. But what budgeting does, and I don't remember who I heard this from, and it took 20 out of the last 23 years for me to hear this analogy. Budgeting is telling your money where to go rather than reacting. And the proactive behaviors become so important, so much so. It was the leading category and where Vanguard found that financial advisors were having an impact. And it was 2%, again, or more.
Yeah.
Because, and the or more, in my opinion, and I know that there's lawyers and compliance that look at this thing, in my opinion, the or more should be in all capitals and bolded and underlined, because when we say or more, to me, it can be infinite.
Yeah.
By making the appropriate decisions on, should you pay this in taxes so that you can spend money on something? Sometimes I love getting coached. I've played sports my whole life. I'm still running and love the coaching experience. I love to be a coach. I coach my kids' sports teams. People want to be coached. I've always believed that. People like being coached because you've played sports, you've had tremendous coaches. Those relationships are priceless because we want to be helped. We want to be guided. We want feedback on the decisions that we want to make, because in the moment we don't trust ourselves. And
Yeah.
and I'll tell you why I think it's having that big of an impact. We've talked about this just in our office. We are watching baby boomers now who are really the first generation to retire with significant wealth that's focused on retirement and funding that retirement. Prior to that, we had pensions, and the stock market was looked at as a rich man's game. And then it became very important because we converted from pensions to 401ks, and the baby boomers, that generation led the way on fully funding their own retirement. However, we know we get our financial patterns and our financial behaviors from our parents. They didn't watch their parents have to do this. So they don't know what they don't know. They don't understand the emotions, the behaviors that come with being responsible for this much money. They weren't taught how to be responsible for this much money. Again, another episode we could go on for days and years is the poor financial literacy that's taught in our public education systems. But they weren't taught. They didn't think they were needed to be taught. It was kind of like me learning cursive. I was learning something I didn't need to. They weren't learning financial literacy where they were going to be the generation that needed it most. So the emotions that go into opening your statement or logging into your account online and seeing the impacts of April of 2025 or the year that was 2022 or the reaction to COVID or 2018 or the financial crisis. Those are strong emotions that will possibly lead to terrible behavior and terrible decisions. And it's our industry's responsibility to guide them through that. And I don't think that responsibility gets quantified enough. I'm glad Vanguard highlighted it and talks about it. And again, they go into much, much greater detail on this. But I think Vanguard did, hit the nail on the head. I'm glad that the results kind of follow what I've experienced in 23 years in this career. I'll tell you what, we were just at a conference, Niko and I and Bryn in our office, and a hill that I will die on in this profession is not just financial advisors. It's the independent financial advisors. It is the folks whose name is on the sign. And you may think I'm biased. I am biased because I know the effort and work that we put in. But it's the independent financial advisors, because we went to this conference. It was called Future Proof. It was looking forward in the wealth management profession. And it was talking about all of the things that not only we deal with every day, but what's coming when it comes to the transition in technology, how AI is going to have an impact. I don't know that I've ever left the conference more excited than I did coming home from California last week. I do think that the wealth management space is in great hands, but to me, it spoke volumes of who wasn't there. That, the great Chuck Noll from the Pittsburgh Steelers, we're a Pittsburgh-based firm, used to say all the time, I'm only worried about the guys in that locker room. And maybe that, and it was great to see everybody that we love and respect and follow, but it spoke volumes and who wasn't there. And this industry is changing, and the independent financial advisor and independent wealth management firm, to me, is where clients are going to be in the best hands. In your short career here, Niko, what have you noticed about that?
So not even in just my short career, just in looking at jobs, like I was,
Yeah,
3 years ago, I was job shopping to
sure.
be a financial advisor. And the draw to being an independent financial advisor is if you go to a wirehouse, you're a copy of the guy that left before you.
Right.
Their trainings are all the same. They're learning from the same people. It's all the same. It's all the
Mm-hmm.
same information passing down the line.
You're right.
And so, that brings a
And
question
it's
like,
the
why
same
does
as the captive shops. And we don't need to get into who, what,
yeah,
when, where. It's just the independent financial space. I think it's where, and it's not even because I'm teaching him well. I think it's where Niko's getting the best education. I think, I mean, the Future Proof conference was 5,000. It seemed like everybody we met was a independent financial advisor or independent wealth management firm that was there because they want to learn how to set up their practice, set up their client experience, help their clients look forward and listen. That's our obligation, right? I mean,
Absolutely. Yeah.
that's why folks hire us. That's why we're in business. We are looking forward when it comes to our firm, our business, our clients' money, our clients' wealth, their family's wealth and progress. And it was it just was after being in this business for 23 years, it was very noticeable who wasn't there.
Well, I think that's exactly what I'm kind of getting to is like to be an independent financial advisor, you have to be different.
Yeah.
Like you have to think outside the box. You have to think of new ideas. There is a value that, I'll just use, well, obviously I work here. So I use this example. Hoffman Wealth Management has to bring to convince you to, leave a
Sure.
wirehouse, and I won't get into any names or anything, but there's a value or something different to the table that we have to offer. And when you go to a conference like Future Proof, every single table I sat down with, none of those advisors were the same.
Right.
They, whether it was their niche, whether it was their skill set, some people worked with only people 100 million plus. Someone was in private equity. Someone was,
Right.
focusing on veterinarians in the Midwest.
Right.
It was incredible. And they had to be different. And that's why they're valued, is because their advice is different. Their
Right.
advice was set to a specific skill group that they knew they could do better than anybody else. And as an independent advisor, that's the opportunity you have to create. That's why that conference is for independent advisors. It was different. It was different thinking. Look at this different tech stack that we give available to our clients because we think that they deserve it, and help
Right.
portray the knowledge or the specialties that we know easier for them. That's why you didn't see some of the major original players there, I think.
Yep. I agree. Already excited to go back. Well,
Absolutely.
make sure that if you're listening, you check out the links that'll have the Vanguard Advisors Alpha PDF in there. We didn't even really scratch on the surface of all the nerd stuff, which is the math that supports these conversations. So it's definitely worth checking out. But it's, thank you to Vanguard for doing this. Thank you to them for kind of legitimizing our profession. Um, it's kind of hard to put care and passion into a chart. And I think that they were able to do it and see, what we are working for, striving for every day with our firm, every year with our business and relationships with our clients, every decade with, how we help them with their legacy. And again, for an entire career for me so far, it's been nice for them to quantify this and really give young advisors and young professionals like Niko the why. This is what you're in business to do. This is the impact you can have. This isn't just selling financial products anymore for a commission. This is, you are handling people's wealth, and you can have a bigger impact than what you realized. This is how they educate their kids. This is how they fund their retirement. This is how you travel the globe and create the experiences. This is how you can say, after a pretty volatile week, it's kind of time to slow it down. I want to spend more time at home. How can I afford to do that? Vanguard is leaning into our profession, and thankful that they were able to do that. Niko, final
Correct.
thoughts.
Correct me if I'm wrong. So when this Vanguard studies happened, it was 2001, right? That's when they started the survey.
Right.
Was that your first year of business? So does this
So
quantify what you've been doing?
I was licensed November 11th, 2022. So I am coming up on my 23rd year
Dude,
in this
2002,
profession.
not 20.
Or I'm sorry, 2002,
Yeah.
November
Okay.
11th, 2002. Right. So
Okay.
this is close to summarizing the impact that I have witnessed firsthand over the last 2 decades, 2+ decades. So it's nice to see it validated, and I have a lot of peers that have been in business that long, a lot of peers that have been in business longer. It was nice to see this quantified and know that, we're not working hard for nothing. But again, 25 years ago, we were selling financial products for a commission, and the business has changed. I've talked about that at length on this podcast. The business has changed. It's getting better. It's getting better with, folks like you who are adding to firms immediately because of places like John Carroll that recognize that there's a legitimate education platform that's necessary, that was being unmet, and they stepped in and created a program, and kudos to them for doing so and recognizing. I can't say it again enough to my peers. If you're listening to this, turn to John Carroll's alums. Leave Niko alone. He's taken, but turn to John Carroll's alums, look at their program, find a program similar, because Niko was able to come in and immediately make a big splash in the deep end of our business. And I'm excited to watch the next chapter of his career, and excited that he's chosen Hoffman Wealth Management to do that. Glad that Mrs. Hoffman had the foresight when he was in 5th grade to say, keep your eye on this kid. Him and Bryn both were in the same class, which is kind of fun story to tell, that, you know, Goldman Sachs has their pipeline, and PNC Bank, we know, has their pipeline, and the pipeline of Hoffman Wealth Management's Mrs. Hoffman's 5th grade class. So it's a fun story to tell, and I'm glad we get to tell it. But if you want to check us out, make sure you go to hoffmanwealth.com. Jeez, it's been a long week. hoffmanwealth.com. You can find my bio on there. You can find Niko's bio on there, and a direct link to be able to email him. Both of us are very active on LinkedIn. So find us there. We'll put our links to our profiles in the notes as well. Look forward to having Niko on for other episodes and other topics to discuss. But until then, until next time, please remember, keep your wealth moving. Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.